Well, you're right. China is really in the centre of the bullseye in investor attention at the moment, and there's great uncertainty what's going to happen in China. The markets are becoming more worried about a hard landing scenario or a financial crisis developing because of the massive build-up in credit we've seen in their economy and the massive property boom that has been experienced in the last 5 years or so in China. To put it in context, in the 5 years from 2010 to 2014, China consumed more cement in that 5-year period than was consumed in the United States in the entire 20th century. So the scale of what happened in China has been breathtaking. Are we going to have a hard landing scenario in China, a financial crisis? We actually think those fears are well overblown. At the end of the day, we're actually not that concerned. It could happen, but we think the probability of that is low. What's actually going on in China? Yes, we have a slowdown in investment activity. There's been quite a dramatic slowdown in investment activity in China. And if you look outside in a broad range of statistics, cement production is now negative. Property construction has fallen very dramatically. Steel production is negative. Electricity consumption is running at zero growth year on year. So there's been a massive slowdown in fixed asset investment in that economy. Exports aren't down, but they're much weaker than they were. That's probably a global economy issue. But on the other side of the equation in China, the services sector is growing strongly. Wages are growing at about 8% year on year, and retail consumption is growing at over 10% a year at the moment. So if you look at the consumer part of the economy, which is growing, it's growing strongly. If you look at the services side of the economy, it's growing strongly. And we would argue the dramatic slowdown in property development is actually healthy if you're going to avoid a financial crisis in China. Another element that's having a drag on the Chinese economy is a massive capital outflow that we're seeing in China. Domestic residents are fleeing the country and they're taking money out. And of course, as money goes out, that's also a drag on the economy. So there are genuine issues, and China is slowing down. And we do not see a rebound in fixed asset investment. We think that's going to remain low for a considerable period of time. But the consumption side and the services side of the economy, it's looking pretty healthy. And we believe that the government, with correct policy, will avoid a hard landing scenario. We're not predicting a bounce back in overall economic activity. We think it will continue to slow, but the fears in the market that you're going to get a collapse in China, we think are overdone. We're not subscribers to the sort of 50% dramatic fall in the renminbi. There are pressures on the renminbi at the moment because we have domestic people in China trying to get their money out, and we're seeing large capital outflows. So of course, if people are taking their money out, they are selling renminbi to buy foreign currency, and that is putting pressure on the renminbi. But as that money's leaving, the People's Bank of China has a very strong incentive from a policy point of view to effectively dip into their foreign exchange reserves and bring some of those foreign exchange reserves home, effectively to offset the contraction in the money supply that's happening as money is leaving the country. And given they've got $3.5 trillion worth of foreign exchange reserves, we think they have very, very substantial firepower to effectively offset, from a policy point of view, the capital leaving the country. And therefore, we think a large devaluation is unlikely because of the strong monetary incentive the People's Bank of China has to effectively buy renminbi to bring foreign exchange reserves home at the moment. The question is how is this money leaving the country? They have a $50,000 limit per individual per year in people being able to take capital out, but it looks like a very leaky sieve. And of course, there's a huge black market where people effectively sell their entitlement and people buy the entitlement. And when you've got over 1 billion people, there's obviously a lot of entitlements there, and we would expect the Chinese authorities are going to clamp down on effectively the rampant abuse of their $50,000 limit per annum. And as that happens, I think he's going to take some pressure off the renminbi. Do we see mild devaluations of renminbi happening? Yes, we do, but a massive devaluation, I think they're underestimating the authorities in China, and particularly incentive from a monetary point of view to stimulate the economy by bringing foreign exchange reserves home. We are quite relaxed at the moment with the sell-off in markets. There are certainly things we're looking at that fundamentally are becoming more attractive. As the price falls, and we're not that worried about a hard landing, and the US is still looking quite robust, from an absolute level of earnings power of these companies, it's still looking pretty robust in many of the companies we look at, and as prices become cheaper, they're becoming more attractive to look at. But we're in a headwind of quantitative tightening in the world, where rates will go up and buying activity by central banks over 3 years is likely to change. So there are still parts of the equity complex, particularly that are very defensive equities, that still look pretty fully valued to us. So we're being patient. I'm relaxed about that, and it's unwinding some of the excesses that were in the system. But certainly on a selective basis, there are some equities that are looking pretty attractive in this environment. I don't want to flag what we're doing intra-quarter, but I'd say there are opportunities that are coming up that are more attractive than they've been in some time.